Hello, everyone, and welcome to today's webinar. We are live on February 16, 2023. This webinar is being recorded. I just wanted to let everyone know. My name is Alyssa Atkins, and I am the Training and Development Coordinator for the Native Learning Center. Just a quick disclaimer before we get started. This webinar provides a summary of fundamental concepts, requirements, and/or procedures within the allotted 90 minutes. The material discussed does not illustrate all possible scenarios that could be applicable. I want to familiarize you with some of the features available and how the environment works. If you look at the top of your screen, you will see an icon of either a person with their hand raised or just a hand. With that icon, you can either raise hand, agree, disagree, or step away. Now your screen should look similar to the graphic here. To the bottom left, you will see a box that says Files. Here you will find today's presentation, which at the moment it is not there, but I will have it shortly. And if I'm unable to get the file attached, we will email it out to all participants who have attended. The second box that says web links to houses today's survey, as well as any other links that are found throughout the presentation. Lastly, to the right of the screen, we have a chat box available. This is how you will communicate to instructor and NLC staff. Myself and Hervins, our new training and development coordinator, he will also be monitoring the chat. If you have any questions during the presentation, please feel free to interact by using the chat box. Simply type your message and hit enter or click that up arrow icon button to submit. We encourage class participation, so please feel free to write in those questions or comments. Tech support issues should also be submitted here. It is with a great pleasure that I introduce Adam Rose, and Joel Smith today. Oh, sorry, Adam. I forgot to mention your course descriptives and objectives. Did you want me to go ahead and mention those, or did you want to
talk about that as part of the discussion? That's fine.
Okay, perfect. I'll go ahead and switch to your slide. Okay, Adam, you should be able to share it.
All right. Can you see that okay?
Yes.
All right. All right. Well, we'll go ahead and get started. Thank you so much to the Native Learning Center for another great opportunity to host a free learning session. All of their sessions are completely free and just provides a really great format and a really great opportunity to continue to learn, continue for all of us to expand our capacity of doing what's important, getting housing built for our communities. I'm really thrilled today to have Joel Smith from Native American Bank joining me as part of the conversation today as well. Native American Bank, I ran into their staff at the clean energy meeting that Native Learning Center hosted last week. And just want to also say to the Native Learning Center, what a great event that was. And the ability to bring all of those experts into the same room as far as clean energy development and energy sovereignty. Again, that's kind of a top-notch, world-class opportunity, and tribes should continue taking advantage of the resources made available from the Native Learning Center. I know some of you that are participating today may have joined webinars in the past. Just to give a quick introduction of our team at Travoy, our work really kind of centers around helping tribes, tribal housing authorities, tribal entities leverage two particular funding mechanisms. One, we're not going to talk about it in detail today. We're going to talk about it very briefly, how it fits alongside another resource that we're going to talk about today. But that tool that we help with is called low-income housing tax credits. And that particular resource, along with another resource called New Markets Tax Credits, for things like clinics, schools, grocery stores, daycare facilities, treatment facilities, broadband infrastructure. Both of these resources are important to tribal communities because they provide a source of equity, meaning that they don't have to be paid back. In both cases, both programs provide substantial amount of funds to projects to help make them viable. On the housing side, maybe that's 70% of a total project cost. On the new markets tax credit side, that could be upwards of 20 to 30% of a project's cost. On a $10 million project, that's $2 million that a tribe could leverage and put back into the project, or put towards a different type of investment. But again, in both instances, it's a resource that's extremely valuable because it does not have to be paid back. So in this capacity at Travoy, we've had the privilege, the opportunity to play a very small role in this capacity, helping our clients, our tribal partners, build or rehabilitate over 6,100 homes across Indian country. This program has helped raise 893 million of equity across all of those projects, 200 plus. And again, that 893 million across those projects is the portion of investment that does not have to be repaid on the leveraging the housing tax credits. We also help with a number of other smaller programs that can work really well alongside these. I think the one that we're going to talk about today and hear from Joel with his expertise from Native American Bank really kind of fits into that category. It is ideal for helping get a project off the ground. It's ideal for helping fund infrastructure. It's ideal for helping fill a gap. And that program today is a program called the Title VI Loan Guarantee Program. So again, it kind of fits alongside and as part of one of these tools in the toolbox that tribes should have on their radar and be able to use and deploy at the appropriate time. With that, I'm going to turn it over directly to Joel and let him talk and introduce Native American Bank. Again, I can't overstate the good work that they continue to do throughout the country, working with tribes and tribal housing authorities and tribal entities.
Thanks very much, Adam. That was very kind, and I will echo that sentiment in regards to Travoy and the work it does in Indian country. For those that are not yet familiar with Native American Bank, we are a nationally chartered bank, a CDFI that is devoted specifically to Indian country, and we work across the U.S. So no geographic limitations. Any state, something that we're comfortable with. We are tribally owned. We are owned by 31 different tribes, tribal economic development corporations, as well as Alaska Native corporations, and a few social investors. So we are a full service bank, FDIC insured, considered a minority owned depository institution. And our creed is Native people investing in Native communities. Our bank did not create a side program to start trying to bank tribes. We were created precisely to specialize in bringing capital to Indian country. I'll highlight briefly for the introduction our lending capability as it relates to tribal housing authorities. We have been one of the most active lenders in financing housing authorities throughout our 20-year existence. We work with tribes financing housing developments, including infrastructure finance, land acquisition finance, working with them in ways that they can sometimes acquire and then convert land into trust. And of course, we have successfully completed a number of HUD Title VI loans. We are well versed in all the programs that are used by tribal housing authorities, including all of the complexities of LIHTC, and will commonly provide both bridge and permanent financing as part of LIHTC projects. So I'm very glad to be here today and share more about all these tools. Quick look at our team. These are the people that you would work with should we work together on a project at Native American Bank. We have Veronica Lane, our lead for our housing lending, Shannon Ward, our chief lending officer, and myself as Chief Credit Officer. And of course, our contact information if you would like to reach out at some point. We'd be glad to help.
Yeah, thanks so much for that, Joel. And our went ahead and put our contact information on the screen. It's also going to be included at the end as well. But if people want to take a quick screenshot of that, do feel free to reach out. I know that Joel and myself are more than willing to be a resource if you're talking about trying to get a project off the ground. So with that, Joel, let's dive into this discussion a little bit more about um, Title VI loan guarantees and where they kind of fit in and how they can be very, very valuable. Before that, I want to just kind of start with a general question to you, and that is, that I am sure that you've seen recently that construction costs they haven't really leveled out necessarily over the past 3 years. That they continue to be generally a problematic challenge where other financing may be in place, but there still may be significant gaps on a project. Is that kind of a fair assumption from what you're seeing on your side?
Yes, and that's spanning across lots of geographies. There's specific ones we've seen that have other issues that are having to deal with a lot of shortage of material and labor because of like natural disaster, rebuild on top of things. But cost per unit going up is a big um, topic of conversation for sure.
Yeah. And I want to start there because, this is the resource. This is the kind of resource and the kind of program exactly where Native American Bank can come in and be a funding source and access to capital to help fill that gap. So the program that we're going to talk about today called Title VI Loan Guarantee, it's a program under NAHASDA. And we're going to get into much more detail about how it works, but fundamentally, it's a guarantee program, right? So HUD isn't providing the funding. What they're doing is they're guaranteeing the loan that you would provide to the project. Is that right? Kind of to start.
Absolutely, yeah. It is a loan with a bank, and HUD works to provide that backstop to make sure that the bank has enough comfort and leeway to give some favorable uh, terms to these
Yeah.
projects to help them happen fundamentally.
Yeah.
Yeah,
And we're going to get into this in more detail as well.
yeah.
But I think one of the things that you and I have talked about is that access to capital in today's dollars is fundamentally going to be less expensive to do it at scale than to try to do that same project over 5 or 10 years. So if a tribe or a tribal housing authority is trying to build out infrastructure and they're trying to build out, to accommodate 50 or 75 homes, yeah, it's expensive, but that construction cost isn't going to go down in the future. So if you can use kind of the economies of scale of a larger project and go ahead and make that investment in today's dollars, that's ultimately going to be beneficial for the tribe, with an assumption that they're going to build that out and they're going to need that infrastructure at some point in the future anyway, right?
Absolutely. That's exactly the calculation that tribal housing authorities are doing to um, develop as many as they can at a time rather than piecemealing.
Yep.
Yep.
So before we get into the specifics of the Title VI loan guarantee program, I thought for the group's benefit and the participants' benefit, we could take a quick, real kind of high level snapshot of a couple projects where these particular projects haven't used a Title VI loan guarantee, but they're very, very ideal candidates where they potentially could or still may. So one of these is a tax credit project at the Dry Creek Rancheria. This project will build single family units. There's a really nice community amenity on the same site. But this project had all kinds of challenges just related to cost, finding contractors, infrastructure, the challenges related to annexation by the city of Cloverdale. So I think this is just one that's extremely representative of the great work that tribes are doing across the country. Yes, it has been challenging. And yes, there have been challenges after challenge, but the Dry Creek Rancheria is just another great example of working together collaboratively with their partners, working together with their architects and their engineers, their funding entities to really figure out how do we make this elder project in this case viable and get low income elders into much needed housing. So again, I think that that's just a great example that construction costs probably are one of the biggest challenges on that project. But again, we're talking about a tool today, Title VI loan guarantee, that goes a long, long way in helping address that. The other one I want to spend just a couple minutes talking about is sort of a different concept, multifamily concept at the Pueblo of Acoma. So on the top right corner, you can see the historic Pueblo at the Pueblo of Acoma. And to the left here where my cursor is, you can see two side-by-side adjacent, now completed tax credit projects, leveraging low-income housing tax credits. And I'm going to go ahead and see if we can play this video here. So as we come up over the hill here, you're going to see the second project that is now complete. They're in the process of moving in the last families to these units. This is 30 units of multifamily housing in the same kind of traditional style as the historic Pueblo. So you see the second level townhomes have a balcony going out. There's this really awesome playground recreation area that kind of right in the middle. And a huge part of this effort at the Pueblo of Acoma was, kind of cultural preservation was absolutely critical. What they continue to realize and have understood for thousands of years is that culture, it continues to thrive because of intergenerational families and grandparents passing on the language to their grandkids. And this setting is really intended to mirror exactly that. So you see here, kind of at the front of both developments, this really nice community center gathering space. You can see the kids on the playground area using the playground. So again, this is, I think, just extremely reflective of the great work that tribes are doing across the country to move their housing and to move their communities forward. And I think that, again, like, these are just intended to be examples, but to provide that level of inspiration that, you're certainly not alone in your work out there. Tribes, I know it's sometimes a tireless, thankless job, but at the end of the day, it ultimately comes down to getting families into good quality housing. And I think that that's why both Joel and I are excited to be here today. So with that, I want to kind of start this discussion, Joel, and move into some more specifics about the Title VI loan guarantee. Again, I want to just reiterate that this is challenging stuff, right? It's sometimes there's headaches, there's challenges. These projects take a long time to get off the ground. But ultimately, if we continue to keep in mind what the end goal is, getting families into homes, getting families into good quality housing, that's really what it's about at the end of the day, right?
Oh, precisely. And any of these projects, I'd say, is a multi-year project. Of course, from concept to even just starting with shovels, and that's something we understand. There's a lot of things that go on with land status. There's a lot of you know architectural design work. Um, so it's not quick, but it's important, and um, yeah, that's why we're all here.
Yeah. I think that something that you guys have clearly demonstrated at Native American Bank is, like you mentioned, you're tribally owned, understanding what those unique dynamics of tribal housing and tribal development mean. Whether that's getting title status reports in a timely fashion, or um, you know, working with land records or the land office to get everyone comfortable. We understand those challenges. You guys, unlike a lot of groups out there, are intimately tied to those challenges, and that's really a benefit ultimately to these collaborative projects, where it's not just one funding source, it's not just one team, it's multiple different teams all coming together to make this happen.
You bet.
So I want to kind of dive into this discussion about Title VI. And again, like, I kind of think about it, Joel, as like, this is one tool in the toolbox. Maybe it's not the ideal scenario for every single project or effort, but the more access and the more tools that tribes have at their fingertips and are able to deploy at the appropriate time, the better able they are to determine which projects which tools make the right sense at the right time. So again, Title VI loan guarantees is one of those. We've helped with several webinars recently on other funding sources, new markets tax credits, low-income housing tax credits. Of course, there's lots of money through the EPA and DOE right now, and the competitive IHBG program. So again, this is just one more tool in the toolbox to enable tribes to move their communities, help their communities move forward. I think one advantage of the Title VI loan guarantee program is that if it's not bundled with or layered with another funding source like housing tax credits, it has the same exact requirements and expectations as NAHASDA, right? So uh,
Yeah.
housing authorities could go up to 80% area median income on a housing project versus 60% on a tax credit level, right?
Yeah, precisely. There's a different segment you can serve if you're trying to be competitive, especially with light tech and reserving units for those that are well beneath area median income. This is more flexible to serve a whole nother segment in need, at least up to 80%, consistent with NAHASDA.
Yeah, and so another couple that kind of relate on here: funding infrastructure and kind of building economies of scale. So you can use a Title VI loan guarantee, and maybe it's again to build out 3 phases of infrastructure. Maybe you're only going to focus on the first 25 of those 75 lots where those homes are going to be located. But it's really advantageous for tribes to put all of that infrastructure in at the same time, assuming that they have a need and there's going to be demand to fill those lots in the future, right?
Yeah, I mean we love that kind of forward thinking where you're spreading out the benefit over multiple phases, so it can be used on a project level basis or on that grander scale.
Yep. And I think the other thing is that we continue to hear lots and lots of tribes say, "Hey, we continue to have a need for kind of middle income housing as well." This might not extend all the way up to say like 100 or 120% AMI, but it's very viable to get a very robust home ownership program off the ground as well.
Yeah, you can use it certainly for home ownership. We've done construction financing that was built as a rent to own situation where tribal members move in, get credit qualified, get their own mortgage, and then buy the buy the unit from the housing authority. So
Yep.
it's not just rental.
Yep.
Um, yeah.
So just lots of opportunities to start using this program. So I think the first thing here that I want participants to understand is again that this is a subtopic, a portion under NAHASDA. Tribes specifically have the ability to access this resource because uh, HUD had sort of started to get an understanding that access to capital is a very big challenge for tribes, and so they put this provision in. Again, what I want to do to start is, I want to make it clear that this is a loan program, and ultimately that loan does have to be repaid, but it's a source of capital and a mechanism to access capital that otherwise might not be possible without the guarantee that comes along with it. So again, it's part of NAHASDA, it's governed by the same rules, but it provides another source of capital in the form of a loan that could go along with the block grant usage or other soft funds that ultimately end up in a project. Anything else that you want to add to that, Joel?
I want to stop and highlight the importance of the nature of the collateral for these loans, right? If you go to a lot of banks and you say,
Yep.
finance my project, they'll say, okay, I expect you have fee simple land, and I can take a first mortgage and have an appraisal on that, and that doesn't work well for a lot of tribes, and with trust land development, that is what has been one of the reasons that tribes have had such struggles accessing capital. So
Yep.
this is built to say the project land is not collateral. You don't have to go get the appraisals. You don't have to go get the all the land reports and everything. Well, except for development, but for the financing side,
Yep.
um, so it's cost saving, it's time saving, in addition to just the real feasibility. That's why fundamentally it exists.
Yep. So I think another important point there is that the entity that can get a Title VI secured loan has to be the same entity that receives the NAHASDA block grant. Is that correct?
Yes, precisely. You can use the money and inject it into another um, subsidiary or something like a LIHTC partnership. but the borrower itself would be the IHBG recipient.
Yep. And so if that's a standalone housing authority from the tribe, again, whatever entity where NAHASDA applies and uses the block grant, that's where Title VI could be an option. Again, we kind of touched on it briefly to start the discussion, but very, very flexible in how it can be used. Pretty much, kind of unlimited ways, the same as NAHASDA can be used for infrastructure or vertical construction or construction funding or permanent financing. Whatever the funding need is, there's lots of ways that ultimately Title VI can make it into a project to help make it viable.
Hey, Adam,
Yeah.
we have a question.
Yeah.
So Josh is saying, I have a question about the funding. Is it available yearly or a one-time thing for each community? If a community got the scatter site project already, will they be available for another project in the near future for another bigger project and so forth?
Yeah. Okay. We're going to come back to that in just a minute, but I think the high level answer to that is that it is based on a tribe's particular formula allocation and how much they receive from HUD. So again, we're going to talk about this in detail, but every tribe receives a formula allocation, and as part of that formula, there's a component called the need portion of the formula allocation. Basically, what's going to happen is we're going to show you how to find what that number is, and then it's going to be an amount times 5 that any particular tribe can get that they're eligible to have guaranteed under this program. Now, Joel, I say that, but that doesn't necessarily reflect HUD's overall credit authority or how much cap that they have and their ability to make a certain amount of loans. Do you have any insight into that, what that looks like currently?
I mean, the allocations change year to year for how much HUD can provide guarantees in total. And it could be 30 million across the country year to year. It varies. So there's a little bit of a sort of total cap, and you can work with your lender to get a read on if there's somehow money not available. We've never run into the situation that we can't get a Title VI loan because nationwide money ran out. You can have multiple Title VI loans. You can have them on multiple projects. There's no limit as far as that goes to answer the question, provided it fits under that calculation of the total multiple of need-based block grants.
Yep, exactly. And then, so again, like my point there is that even if every tribe, the problem would be is if every tribe went to try to get a guarantee, we could potentially bump up to how much credit authority that HUD ultimately has to make guarantees. But typically, that's not a challenge in that there's enough credit authority out there where tribes can get the guarantees that they need. So the way that this works is that a tribal housing authority, as an example, they're able to use this loan guarantee program. And with it, HUD is providing a 95% guarantee of those loan funds. And so what that means is that if there was a default on those funds, that you, Joel, as the lender, you're 95% protected, but you could also be protected and make sure that the other remaining 5% is collateralized through some other source, right?
Yeah, I mean, banks have historically sometimes asked for some additional collateral like cash to backstop the remaining portion that the government doesn't. Native American Bank doesn't do that. So it's effectively unsecured from our perspective, and then the backstop comes via HUD and the fact that they can direct the need-based IHBG pledge to service the loan.
Yep. And so you hit on it before, but let's just come back to it. So you said that the land itself is not the collateral, right? So tribes have this unique ability, this unique resource that is committed to them for housing development. It comes in the form of the block grant. So again, we're going to get into a little more detail, but what becomes that fundamental source of collateral in the event of a default?
From the perspective of the bank, here's how the backstop works. It's actually I will say this: in the history of the HUD Title VI program, there has not been a default that has led to a loss or a claim against the government. Um, IHBG is a dependable every year source of funds,
Yep.
and should there be an issue with something falling behind on payments, the bank would tap HUD on the shoulder and say that need-based portion of IHBG was supposed to cover that payment, and then they will direct it there as long as the tribe is in good standing with HUD, or with the housing authorities in good standing with HUD. If it got into such a bad situation that the IHBG funding was at risk because of compliance or something, then the bank could say to HUD, will you just pay off 95% of this loan?
Yep.
And so none of that involves like taking the house
Yep.
or any sort of foreclosure.
Yep. So it's interesting because the collateral essentially becomes that future stream of NAHASDA block grant that the housing authority or the tribe is promised, right? So it's not the land as collateral; it's the future block grant proceeds that HUD knows and understands is ultimately going to come to the housing authority.
Yeah. And really only to the extent that it would be needed to make the payment. So if you had $1 million a year of need based block grants, and the scheduled payment on Title VI was 100,000 a year, they'd say, okay, make sure you pay that 100 from there, but they wouldn't take the whole million,
Correct. Right.
right?
Yep. So let's go back to collateral because I think this is another very important, unique, defining characteristic that's different, makes Native American Bank different than some other groups. So, you know, most groups, you would think they would be happy and satisfied with a 95% loan guarantee. But there are banks that require some other type of collateral of that remaining 5%. So there's different ways that can be handled. It could be some type of cash collateralized account. It could be bank deposits with that particular bank that maybe earn some interest. So there is a mechanism. HUD does allow for an institution to collateralize that other 5%. But like you said, that's not the case with Native American Bank, right?
Right. Yeah, we do not require that. We do give consideration to if housing authorities do have money on deposit, they can get sometimes better terms, lower interest rates and things to like leverage that relationship, but not that it's a collateral requirement.
Yep. So I want to talk just kind of high level again about the idea of like risk mitigation. So a client comes to you, a tribal partner, a tribal housing authority, and they say, "Hey, we want to use some debt strategically. We're going to fund some infrastructure as part of a larger project. We have this ability to get a 95% loan guarantee through Title VI. How does that impact your kind of risk assessment of a particular project, and why is that valuable to have that guarantee from a lender's perspective?"
So from a lender's perspective, that backstop lets us kind of, as I described earlier, really sidestep a lot of the normal collateral process that banks look for comfort, right?
Yep.
And it's federal government backed, which is as high of a credit quality as you can get. So we honestly don't understand why there's not more banks striving to do these. There are a good handful of them. It's somewhat of a niche program, of course, and it takes understanding. But we consider this the best kinds of loans that we like to do because of the structure of the backstop, because of the um, mission orientation that we have in seeing these developed in the housing developed in Indian country. So it's it's a really powerful structure, is what I'll say.
Yeah, and I mean it comes like you said with the full faith and credit of the U.S. government. So that guarantee applies regardless of if there are changes to NAHASDA in the future. And most lenders assume that there really aren't going to be changes to NAHASDA, but the guarantee is still in place and enforceable, even to the extent, like, hypothetical, let's say it were to go away completely next year, the guarantee is still going to be good, right?
Yeah, precisely. Yeah.
So let's kind of dig into a little bit more how a particular tribe would go about calculating how much they could receive as far as a guaranteed loan through HUD under NAHASDA. So in this particular case, I don't remember which group it is. I think this was the Seminole Nation of Oklahoma that I used as an example. And in their example, um, their overall allocation is about $1 million. But more specifically than that, pretty easily, if you go to, I think the way that I typically do it is on Google, just go to NAHASDA formula allocation. And then in the middle of the page, there's a 2023 final amount Excel spreadsheet. And it has every tribe in the country listed. And it has, I don't know, about 15 different columns across the top. But a very, very important one is about 2/3 over, and that column is need portion. And that's the amount that you want to be focusing on to identify what your amount would be of how much Title VI secured loan that you could get. So all tribes, again, that amount is variable. In this particular case, I would say that this is probably at the lower end of what maybe a smallish, medium-sized tribe might receive as far as their need component of their formula allocation. I think for some reference, like the Turtle Mountain Housing Authority in North Dakota, their overall loan authority that they might be able to secure with Title VI is probably closer to 12 million or 13 million. So this is probably in the range of a small to mid-sized tribe where their need component in this case is $699,894. What you do is you just take that amount times 5, and that translates into the maximum amount that HUD would issue a loan guarantee for a loan up to that amount. Is that right?
Yeah, you got it.
Yep. So we're going to
Easier
kind of
math than LIHTC.
Yeah. No, it's pretty straightforward. 5 times the need portion of the formula allocation. And again, you could have multiple loans, kind of covering different projects. And as you pay down those loans, what HUD is looking for is that your guarantees don't exceed that 5-time portion across the portfolio of projects.
Yep.
So again, we touched on this briefly to start the conversation, but this is really a tool to fit in with exactly what tribes are doing. There's no real minimum on like project size. So it could just be for $1.5 million worth of infrastructure, and that's it. It could be for in combination with new housing. It could be in combination to rehab existing housing. Maybe you're only going to do 10 units and you say, this project is not big enough. We don't feel like we have the capacity right now to take on a tax credit project, but we want to continue moving forward, and we think that this is a good way to do it. So again, it doesn't have to be tied with any other type of funding. It can be kind of a small project. It could be a larger project that has multiple different funding sources. It can be just for infrastructure. It can be for vertical housing. It can be for community amenities. It also can be for land that ultimately is going to need infrastructure development in the future, but you can use Title VI just for a straight land purchase as well. Is that right?
Yeah, you bet. It's pretty flexible, including land acquisition.
And I think the other thing that we see is that it can be used kind of both in a construction financing setting and in a permanent financing setting, with a lot of scenarios where it's kind of converts from one to the other. It starts off as construction funding, is drawn down during construction, and then converts to permanent financing at the completion of the project.
Yeah.
So very flexible there as well.
Yeah, we'll do single close, and really that's how the program should work. If you're going to do a permanent loan and start funding during the construction phase, you'll have up to 20 years, which is right there on your slide, between the two of them. So if construction takes 3 years, the permanent phase would have 17 years to run, so to speak,
Yep.
with that converting loan.
Yep. And so a group comes in and they say, hey, Joel, you guys have always been a good partner. What could you do to help us with respect to a Title VI secured loan? What are the questions that you're starting to ask, and what kind of how do you start to view it from an underwriting perspective about how you can make that loan and what ultimately your rate might be that you can provide for that loan?
Great. It's interesting because of the strength of the program. We do, of course, underwrite and look at financial statements and the condition of the housing authority, but we really turn into like, can you build the project? Right? You need to use the funds to complete the project, and how does that look? So a lot of the list is a lot of the same development stuff around how it's coming with land control and um, construction costs and the like. Um, we will price these pretty much better than any other kind of loan. As I discussed, it kind of
Because
depends on
of
the
that
interest.
guarantee, right?
Yeah, precisely. I mean, the strength of the program, and these are the kind of loans that we want to do, and I hope that's the same for other banks that may be motivated by getting credit for serving their community through the CRA, Community Reinvestment Act. But um, so I would check in. It should be maybe better pricing than you may have gotten quoted on other types of projects. Um,
Because
you
it's
know,
less risk for you, right? I mean,
yeah, yeah,
that's
precisely.
kind of the
Um, yeah, I
appealing
mean,
factor.
that's how we view it. Um, we have also been um, flexible in terms of the payment structure. I'll take from your slide here, but um, you know, if you have your block grants come in a certain time of year or annually, there's no reason that you need to make this fit into a monthly payment as if it were some other kind of project. If that's really what's backstopping this, if you have the rents coming off the project that you think is going to be um, servicing the debt, then you can make it monthly or quarterly, right? It's flexible.
Yeah, and I think the other thing there to your point is that so let's take infrastructure as an example. That infrastructure isn't going to have cash flow that's helping pay that debt off, right? So that is advantageous in a scenario where if a tribal partner can make that payment annually, again like that they have to have that infrastructure in, but until those homes are built, there's no real rent collection mechanism that's even plausible until those homes get built, right?
Yeah, um, precisely. Yeah, we can um, really change the terms to match the project and the needs of the housing authority and where ultimately money is coming from, right? If you're keeping rent below market intentionally, right, it may not be that rents ever cover the um, scheduled payments depending on how quickly you want to pay this off. I will say you can pay it off as quickly as you'd like. So you could
Absolutely. There's no
set it up
prohibition
on a
using
yeah,
cash.
set it up on a 20-year just to
Yep.
have flexibility, and then if you have extra funding, you can throw money against it to try to retire and minimize the interest cost.
And just plan accordingly that, benefit from that longer amortization period, but plan to say, hey, we're gonna apply some more to the principal every year and we're gonna pay this off in 5 years, but we'll have that flexibility of a longer term if needed.
Yeah,
Hey,
and even
Adam,
better, go ahead.
I'm so sorry, Joel. Sorry about that. I was just going to say that Mark had a question.
Oh, sure.
He says, why don't tribes use all the Title VI lending authority every year? In light of this underfunding, how can the allocation be better used? Especially since there is such a high guarantee, why is the program underused?
Yeah, well, I think that some of that goes to, good thinking by tribes that, not all debt is good debt by any means. I think that some tribes continue to have an aversion to any debt, but I think my thinking, my philosophy would be is that there could be very, very strategic and very um, use of debt in a very good way. So if you can get it, and you can go to a partner like Native American Bank, and you can get that, for lack of a better term, cheap money, and that money is going to be available, in today's dollars to help you build it out. I think that that's perfectly appropriate use of debt. Now, some tribes, they say, hey, we don't want to take on any debt at all. We're really risk averse, and we don't want to carry debt. And I think that's perfectly fine. But that's probably the reason that the program is a little bit underutilized. What's your thought on that, Joel?
Actually, I agree. That's right along what I was going to say. You talked about it's one tool. There are a lot of tools, and they often successfully develop a project utilizing AHP and other grant sources and tribal funds or ARPA, right? That successfully pay for the entire project, so it doesn't have to have any debt load, and that's great, right? And we want to get the message out that if you did all that and you still are short of how to pay for this thing in total, that's exactly the most powerful way that this can play in. And a lot of it is just um, familiarity or awareness. I'll call it, right. Not every tribal housing authority um, director or staffer out there even knows this exists still,
Yeah.
right?
And I think another thing is that you can be very strategic about it as well. And our hope would be that, there's some thought about what the rents can and should be, and that that there's a rent structure that helps pay off debt like this. So that's how every other project and community operates, where they use the cash flows from the project. And that's not to say that we would advocate for charging exorbitant rents, but even just charging slightly more than sometimes is charged, that can give that cash flow so that the project is paying off the debt rather than the future block grant allocations. So again, we talked about that this is a loan. It does have to be repaid. Joel talked about how it can extend up to 20 years. So you use the example, Joel, of maybe it's got a 3-year construction window, and then it would convert to a perm loan after that for the remaining 17 years. Can you talk again, or maybe just simplify my explanation of it, of why a longer amortizing period can be beneficial and what ultimately that does?
Sure thing. Well, if you try to say that you're going to repay the loan in a shorter time period, maybe you say let's try to pay this thing off in just 5 years. Maybe it can afford to do that, right? But that'll take a lot of extra cash that would otherwise start accumulating for you to save up and then use as seed for the next project. Of course, there's that one is the biggest one. But of course, if you go longer, you can always pay faster, but you are not required to. So you build in flexibility
Yep.
as well. So those are the major considerations in how to structure the long-term side of these. It has that capability, but sometimes it's just bridge, right? Where you have money coming in later, but you have to get through construction. That works perfectly fine for just 3 years at a time or whatever um, the project would dictate.
Yeah, and we're going to talk specifically about a case study that I know that you guys were involved with, a project that was a tax credit project, still is a tax credit project, but leveraged housing, a Title VI loan guarantee program for that very reason. So in that particular instance at UROC, they knew that they had another grant, but it was unclear that those grant funds would only come into the project as permanent financing. So what they did, and we're going to elaborate on in just a little bit, but they basically used the Title VI loan guarantee as that construction financing source until that other source of capital came in. So again, just another way that it could be kind of factored into the process. So Title VI loan guarantee, it is a guarantee. It's not a grant provided by HUD. It enables tribes and tribal housing authorities to access a loan that they wouldn't otherwise be able to get. It's also, again, it's irrespective of any changes that could happen with NAHASDA. If NAHASDA were to go down a little bit, that doesn't change the full faith and credit of the U.S. government making this guarantee. Again, it's collateralized with, basically saying that we understand, HUD understands that the tribe is going to have allocation of future block grant in the future. It's not the project cash flows aren't necessarily underwritten to require that repayment. The land itself is not the collateral. So it's saying, hey, we as a tribal housing authority understand that we're going to have to use some of our future block grant to repay this debt if we go this route. Again, it is debt that typically does have to be repaid, but it could be structured in lots of different ways where maybe it's an annual payment, maybe it's a quarterly payment. A lot of flexibility, like Joel hit on how that works. And again, like, it's a risk mitigation tool. So if you were to go in and you're a tribal housing authority director and you say, hey, I don't have a guarantee, I don't have the ability to get a guarantee, you might likely you might experience a higher rate, right, Joel, than the really favorable terms that you're going to be able to provide on that loan. Is that fair?
Well, certainly there's the case of you will get more favorable terms. Um, depending on the bank you go to, it's not like um, they'll answer yes and then answer it better. If you have a Title VI, the answer might be no. They're not comfortable with are familiar enough with tribal housing development in general to even um, give you the yes on a conventional basis.
Yep. So it goes a long way to accessing that capital where it's going to be a challenge otherwise.
Yep.
Yep. So I think we've kind of hit on it here, but the really key part here is that there is a lender. There's an entity like Native American Bank involved, alongside the tribe or the TDHE, with HUD providing that 95% guarantee. So Joel, let me ask you a question. A group is contemplating, hey, we have run into construction cost overruns. We're $3 million short on this particular project. We don't have another really ideal source of capital in hand right now. Maybe there's some other sources that we would look at in the future, but what's the next step? How do you as a lender get involved, and when should they be contacting you, and what do you want that conversation to be on your end?
Great question. And also another quick thing to highlight that you did touch on is that you of course can come at this as a needed item to get to close um, the funding and start construction. If you are mid construction, that's fine as well. You
Yeah.
can come in midstream if there's an identified need and come in.
What's an example of that? Does one come to mind?
Yeah, we had a Montana Tribal Housing Authority that was doing a LIHTC project that had some overruns, and they came to us to do some bridge financing um, to to plug into that project that they hadn't contemplated initially. Um,
Yeah, so
and
it could be a mechanism to kind of help. Maybe there's some other expenses that come up in between, and investor equity isn't going to come in for another 3-4 months. It could even be just something that is helping the housing authority pay expenses until those other equity injections come in. Is that right?
yeah,
Yep.
you bet. And so we would be glad to plug into Tribal Housing Authority developing a project, in the year and certainly months leading up to when they to hope to get going. That's when you ought to be arranging for your financing. It's something where you generally have the cost nailed down, even if not the final contract, something pretty close, to really identify the size of your financing need. And a lot of the other legwork that is in some of the pre-development is already underway for site control and um, design, of course. And you're showing on the screen the checklist, right? It's a one that's dictated by HUD that we would all follow as lenders here. And you can work off of it yourself if you have a consultant like Travoy, for instance. They can definitely help you um, go through that, because that is the package of information that would be needed. It's spelled out. We can send it to anybody at any point to work off of. Um, and it's the same kind of thing you'd expect from developing a construction project. Of course, you can do renovations too. It's not just new builds, but um, yeah.
Yeah, I mean, really, this is like kind of the due diligence outline for any funder that's going to be part of the project. Not only HUD, not only the Title VI lender, but all of this same information is very much applicable to your AHP provider or your LIHTC equity provider. This is basically the kind of the short list of things like we want to understand in detail what the project is, who's doing it, how it's going to get done, what mechanisms have been in place to ensure that this can happen, what's the capacity of the team, so that everyone involved sort of has a full and complete picture. And again, I kind of think about it as proactively working to to identify and to mitigate any potential risk. There's no project out there that doesn't have any risks. So this is all just part of the process to say, hey, like, before this becomes a problem, let's figure it out now and work as a team to collaborate so that, an environmental challenge is not really a risk. It's just, it puts everyone on the path to the next steps to correct it or to make sure that it doesn't become a bigger problem in the future. Is that fair?
Yep, that's fair.
And so I think HUD has those same exact questions. And, obviously they're not involved in the day to day of the project. So I think that they use this mechanism to really get an understanding of what the project is, who's been thinking about it. Are we thinking about all the correct things? Because what I found is that when we're all working together on this, we're all able to more easily identify, like, oh, hey, like, have we thought about this? Have we double checked and uh, are there any cultural issues that we need to be aware of? Or, maybe this was noted on a survey. Do we need to ask some more questions about that? So as more people kind of are brought onto the team and helping a tribal housing authority, we're all kind of working together. You as the lender, maybe it's a consultant, maybe it's the architect engineer, and ultimately all of those heads kind of put together are going to be a ideal outcome for the project, just to make sure that all of those risks have been identified and mitigated before the project gets under construction.
All stuff that you would do whether you had a loan or not, right?
Yeah, right.
Yep.
Whether the guarantee is applicable or not. Yep. So I'm not going to get into a ton of detail on kind of these final steps. I think maybe Joel, you can just kind of talk about like big picture, like what is HUD looking for to be able to actually write and make that firm commitment of a guarantee for the project.
So there's, I think, a subset under that checklist for um, the bulk of the items they need to have submitted in terms of making a firm guarantee. The unique thing about this program is they actually will start looking at a tribal project earlier before you even are yet done with getting the approvals from the bank, and they can actually issue a preliminary letter of acceptance.
Yep.
And so you can work with HUD directly um, and do that, and you can actually take that, PLA they call it, to a lender and say this is already sort of vetted by HUD, as it were, as the guarantor. Um, and so, for the firm commitment, you'll need pretty much the whole checklist in there, along with the lender's approval sent us forwarded to HUD. They're generally pretty good about turnaround times. There is a timing aspect of how long the HUD might take to underwrite and approve, depending on their staff and their workload. But if it's a full package, then a 30 and 60-day, maybe worst case kind of timeline, I would hope for that step.
Yeah, and I think that you're exactly right that this step isn't like mutually exclusive of all the other steps and all the other funding sources that might be applicable. So let's say it's a tax credit project and there's an equity partner involved. There's likely weekly closing calls happening. And I would fully expect and hope that HUD is able to join those calls. Maybe you as the lender start joining at the appropriate time as well. So again, this overlaps and touches on everyone involved on the project. So if you can involve HUD earlier, involve your lender earlier in that process, you don't have to repeat the due diligence process. You can kind of do it all at the same time with the conversations that are happening with all the team members.
Yep.
So again, I think that just want to reiterate here is that the planning process for any particular project, that might take a full year. You might spend a year preparing a tax credit application. Um, on a tax credit project, it's after you get a tax credit project that you start due diligence as far as like construction documents and kind of getting the financing in place to get to closing. So that's probably really the time where kind of as the project turns from the pre-development phase into a bigger concept, as the numbers get finalized, that's probably the ideal time to reach out to you at Native American Bank, right, Joel, and say, hey, like, we're anticipating this gap. We're going to submit a tax credit application in the summer, but we won't know about it until, December. We're
Yeah.
looking at closing, maybe first quarter of next year. Can we start this conversation about your ability to help us make a loan to this project to help make it viable? Is that maybe a good rule of thumb of when you could get involved?
Oh, you bet. And that's really actually where you get a lot of value, because a big piece of the puzzle is, what does this piece look like, right? Because you're working with either consultants or yourself on paper to say, A, how do I pay for it? And B, how does it cash flow? And that all depends on, right, what interest rates are, what a structure could be. And so it's pretty helpful at that stage, um, to start talking to NAB or whatever bank, to plug that in, even if you don't yet have your LIHTC application um, submitted or awarded.
Yeah, and I think that, I mean, I'm certain that you're like a lot of other groups, that you want to be a resource at that phase as well. And if we can all kind of collaboratively work to identify challenges and kind of work through those together, it's a better outcome for everyone involved. So if you can be involved in that kind of early phase, thinking about what's going to be best for the project from a loan standpoint, that's going to be to everyone's benefit.
Yep.
And then again, like, what I would see here is like, Joel's team, they absolutely have to be at the table for the financing closing discussion. So part of the due diligence with the tax credit investor, maybe there's some state funding involved, maybe there's another HUD grant on the project. They're all coming to the Zoom call that happens once a week. At some point their attorneys get involved in sorting out and discussing the legal documents. But the sooner that Joel's team can be involved in those discussions, the better able that, and I don't want to speak for you, but that you're able to evaluate the risks of the project and to make sure that you're offering the best possible terms to make that project viable.
Yeah, and we are also very willing to share our experiences in the process that other housing authorities have gone through, and some, the tripping hazards and things to think about. So um, it, that's something that we'd be glad to do early on, that other banks might be um, of a more of a talk to me when you're ready to close in a few months, and
Yep.
we'll take it from there kind of thing.
Yep. Sure. So let's just kind of dial down on kind of a simple example to start with. Let's just assume that a tribe is trying to put in 3 million of infrastructure, and that's going to facilitate, maybe 25 or 30 new homes in the future. There's not yet a plan of what that vertical funding source is going to look like, but everyone understands, like, we got to get the infrastructure in. That's going to be priority number one. We're going to focus our effort on making that happen before we think about vertical construction. So again, I go back to our original example. This particular hypothetical example, the tribe, their need component of their formula allocation is $699,894. Simply take that by 5, so they could get up to 3.4 million, 3.5 million guaranteed through the Title VI loan guarantee program. So kind of right off the bat, checks the box. Yeah, our engineering estimate assumes it will definitely be under $3 million. So we're good on that. We kind of move down this path that this is going to be a viable source to fund this project. Again, the need component portion for this particular tribe is about 699,000. This loan might have something like a, I don't know, 7% interest rate, something like that. What currently are you looking at when you're talking about terms and conditions with your prospective clients, Joel?
As far as interest rate,
Yeah.
yeah. Um, so the interest rate environment has certainly changed a lot. I think 7% would be a safe one in this current rate environment. Depending on the project, that could be lower,
Yep.
even still today. And it's all higher than it was, a year and a half ago.
Yep.
Certainly. But if you're just back of the envelope and finding a rate that's neutral to any bank, that would be something I would hope would be safe for you to use. But again, um, we could find ourselves lower than that.
Sure.
Still, yeah,
All on a project by project basis. Yep.
yep,
And so in this particular instance, just kind of those base assumptions, $3 million at 7%, that would amount to about a 293 debt service payment, 293,000 a year. So again, the tribe would have to be willing to set aside that amount. Now they could use other sources, they could repay it sooner. There might be, in this case, there probably isn't cash flow yet because it's just building straight infrastructure. But again, this could be that mechanism to get $3 million of infrastructure installed at today's cost versus trying to drag that out over the next 5-year period. So let's just take this one step further and see, like, well, what about, leveraging this alongside a larger housing tax credit project? So in this particular instance, I just assumed, maybe it was a project for 20 homes for families, maybe 1.4 million of infrastructure required. There's been some due diligence with your architect and your engineer, and everyone's kind of comfortable with the assumption that it's going to be right around $7 million to build the amenity plus these 20 homes at $265 a square foot. We assume that there would maybe be a third-party general contractor involved. So overhead profit general requirements assumed to be paid to that third-party general contractor. Maybe there's a pretty big contingency at this point because, new construction, but, there's still unknowns. We're still trying to make some assumptions. So building in a pretty healthy contingency into this budget to start with. Of course, you're going to have your soft cost and your professional fees for your architect, your surveyor, your engineer. Maybe it's a tax credit project and maybe you do have those expenses that are specific to a tax credit transaction. So a market study or a final cost cert to be completed by the tax credit accountant. So that would fall into this bucket of other soft costs. And maybe there's a reserve that's built in to cover some operating expenses in the future. And then typically what we see is that the tribe or the tribal housing authority will act as the developer for a project like this. So that developer fee ultimately comes back to the tribe or the tribal housing authority. So we'll just call this an $11.9 million project, all in with the infrastructure, soft cost, and the 20 homes and the amenity to get this project done. So one way to think about how this gets paid for is that this is a project that plausibly generates about $7.1 million of equity. So again, we're not going to talk specifically about how that works today, but it's very plausible that housing tax credit equity could pay for a significant portion of the project cost with a resource that doesn't have to be paid back. Now, that still leaves a significant chunk in this instance, about 4.6 million, that would have to be funded by the tribal housing authority. So this is really where the value of the Title VI loan guarantee comes in. Because in this scenario, maybe the tribe says, yeah, we've been saving up. We have 1.6 million that we can contribute to the project, but we still need some other mechanism. These costs end up, they're higher than our assumptions from a year ago. So we do have this gap. It's going to put in a little bit more infrastructure to accommodate future development as well, and make sure it's sized appropriately for future development. So this is where Title VI comes in as a very valuable resource. So otherwise, it might be difficult to fill this $3 million gap. But in this scenario, there's a very viable path where the tribe could say, hey, we're going to kick in 1.6 million. We have some cash and reserves built up. However, we're going to go to Native American Bank and we're going to ask them for their help and their partnership in this to help make this viable. And again, so that's where a $3 million loan could come in to make this project possible. Now, again, those assumptions would be exactly the same as we looked at before. It would require that the housing authority repay that debt, but in the process, you're getting 20 homes into families in an 18-month 2-year period of time versus over, say, trying to build those units out over a 5 or 10-year period. Does that make sense?
Yeah, it certainly makes sense to me.
So I want to kind of talk about a real life case study here, and again try to apply this same set of assumptions and kind of talk about it specifically in the context of a project that we mentioned before, and ultimately how this project came to fruition. I think the first thing to note about this project is just the design of the project overall. So this is a project, it was fee land in the city of Arcata, California. The UROC Housing Authority purchased this land, but one of the interesting things about the site was that it had already been pre-approved by the city's Development Planning Commission for a particular layout on the site. So when they bought the property, they basically had to design the units to conform with the footprint of the layout, the site layout that had already been approved by the city. So a lot of flexibility in what the final design for vertical construction looked like, but it did have to be designed into the context of this pre-approved site plan that had already been approved by the city. So where they ended up ultimately is that there's a series of these multifamily buildings. So here are 3 townhomes right next to each other. They have a first and second level that goes up to the second level, and then on the end here is where there's 2 stacked apartments right on top of each other. On that same site, this is the multifamily building. So on that first floor, again, about a 900 square foot apartment, and then 3 side-by-side townhomes with an attached drive-in garage. You go up to the second level of that apartment, and there's a second floor apartment of about 900 square feet, and then the second level of those townhomes adjacent to it as well. I think there's 5 or 6 of those on the property. But in addition to that, there's also a series of these single family units. But what's really interesting is that tucked back behind here is a little accessory dwelling unit. So they were really trying to be cognizant of getting as many units on the site as possible, while maintaining kind of a single family aesthetic for these units. So what they did here is at the back of the unit, there's this little 480 square foot accessory dwelling unit. And it's been perfect. It's gotten a really great response from young professionals looking for housing. Maybe it's a tribal elder that says, "Hey, like I don't need a 2-bedroom house anymore or a 3-bedroom house." So that elder can live in the accessory dwelling unit, and then the family could live in the rest of the unit. So this is actually a duplex with 2 totally self-contained units. Grandma and grandpa have their private entrance here in yellow, and then the rest of the family enjoys the other living space that's available. Now, this project is now complete and really just turned out to be a fantastic project. But this one, it absolutely came to a point where Title VI had a very, very important role in this particular project as well, right? So do you want to talk a little bit, Joel, kind of about what that looked like and how that came about?
About the NAB's role in UROC. So in this case, UROC had done a great job of getting some grant funding from the state,
Yep.
Principally that was going to be there to pay for this project. However, it was not payable until they had completed and I think stabilized the project. And
It
so
was a
that,
substantial amount too. I mean, it was several million, I believe.
oh yes, without getting into specifics, it was several million. That was truly, this was the best use of, or example of a bridge need. There probably is still an amount that might be left yet unpaid for that will become permanent, but most of it is designed to help them do the project now, even though their funding source they identified is not yet available. And there's some out there that are reimbursement based, right?
Yep.
Yeah.
And so they came to you and said, "Hey, Native American Bank, is there a way that you can be a partner in this and provide that essentially bridge funding, construction funding, whatever you want to call it, to make it viable?"
Precisely. Yep.
And so again, like this is just representative of lots of different funding sources coming together, team players on the team coming together for the success of this project. And you can see the tremendous outcome. You know, these are now fully occupied. It's you would never look at this and say, you know, this is the old HUD housing of old, or even that this is low income housing. This is something very, very that the entire community is proud of, and all of the residents are, you know, have a nice quality place to raise their families, and those are all extremely important things as well. I know we're almost coming up on our time. We have a few minutes left. So, Awista, I want to stop there and see if there's any other questions in the chat before we talk about any other, just a few more case studies.
Nope, no questions so far.
Okay. I think I want to close and just take the opportunity to, again, like just highlight some of the great work that tribes are doing across the country. A lot of that work every single day involves Native American Bank as one of the players. You know, I think that, you know, this notion that, you know, I think that all of these examples are very, very reflective of what it means for tribal housing today and what tribes are doing and what they mean as partners. And I think that that should provide lots of assurance to groups like Native American Bank. I think it's very apparent and obvious to them, but groups in the lending space that, you know, are looking to continue to provide and help tribes move forward, that, you know, these are the types of projects that tribes are doing today. And it's really reflective of the great work. This is at Pasquiyaki. So a single family project building single family homes. It's on the same site as a project that will build some townhomes. And then adjacent to that project is a multifamily project that's now under construction. This is another great example at Tohono O'odham. And I think one of the things that's really interesting about this particular project is how they have brought together a number of different funding sources. So as we kind of roll through the subdivision here, these are single family detached homes. And then down here towards the end, there's a series of amenities that they use different funding sources to really make into one kind of giant community amenity for the community. So let's go a little further. So this is actually two different buildings here, one using competitive IHBG funds, and then the other using housing tax credit proceeds to build this really nice amenity. And how that has transpired and played out is this here. So on the left, there's a gymnasium and then a recreation facility, a workout facility. But in the middle of that project is this really kind of cool covered patio area, pergola area that attaches the two spaces with this awesome splash pad kind of connecting the two in between. This is now open and functioning. Really nice gymnasium on the one side and then a workout area on the other side, but kind of connected by that outdoor amenity. And that really enabled them to think about, how do we use multiple different funding resources to kind of bring these two things together to really enhance the overall viability and use and function of this amenity. That's a pretty cool one. I think I'm going to show you just one more example, a single family project. This one is here in Kansas, where our office is in Kansas City. And this is a single family project developed by the Prairie Band Potawatomi Nation, their third tax credit project. Again, using lots of different sources, affordable housing program grant, tax credit proceeds, some unrestricted tribal funds that were available to develop this series of 3, 4, and 5 bedroom units at Prairie Band in Kansas. What I would kind of advise and think about as a part of a project like this is that a single family project can kind of occur in phases. So in this particular project, this first phase probably took about 6 months for these 6 or 7 homes to be completed, but they were able to move in families and then kind of keep rolling into the next phases. Even on this 27 unit project, it probably took about 15 months total to build the entire project, but there were families living in the units sooner than that. So again, just very reflective of what tribes are able to do and are currently doing day to day.
Yeah. And you can use workforce on staff construction if they have that experience, or an outside GC to do these projects. I mean, that's on the Title VI side. It depends on your light tech investor, maybe if they have an opinion. But again, these are great companions to low-income housing tax credits if that's the way you're going. But they don't need to be just that. They could be standalone infrastructure. They could be standalone, 20-unit subdivision that you don't need to wait for the competitive
Exactly.
low-income housing tax credit process and you're ready to go now, right? So again, very flexible, and so can be
And I think just
powerful.
to reiterate though too, Joel, like size of the project doesn't matter. So there's no timing date restrictions. It's really, again, whether or not HUD has that ability under their current year's credit authority to make a guarantee. But there's no you don't have to apply by a certain date. It's
Right.
really on a rolling basis to the extent that HUD has the capacity to issue the guarantee.
Yep. Good point. You're
The
not
other
trying
thing
to
just to,
race to some deadline.
right. I think the other thing to reiterate here is that, again, it could just be for something as simple as we need 4 duplexes. We need 4 units, 4 elder units. This is not going to be a big project. It's not big enough scale for some of these other funding sources, but it's really important to the community, and we don't have any, we don't have any good quality elder housing. So we want to just focus on getting these 4 units done. A small project like that maybe is only less than $2 million, that could be a very appropriate fit for a Title VI loan guarantee for sure, right?
Yep, you bet.
So with that, I'm going to ask Awista again here real quick. Are there any other questions? Me and Joel are happy to be a resource if you're thinking about ideas or run into challenges on your project. We have a few minutes left.
No questions yet. Certainly we'll let you know if we have any, but not any yet.
Okay. Well, then with that, Joel, I want to thank you for joining the discussion today and your great input and insight and the work that you do every single day there. I appreciate you joining the discussion. Is there any final comments that you have to kind of wrap up the discussion today?
Well, I will say thank you for leading the discussion, and tell everyone, if there's anyone that knows their way around tribal housing development, it's Adam and it's Travoy. That's first on my list. So as a means for support, and thank you again, and thanks to all the listeners. Be glad to work with anyone to help make some homes happen.
Yep. Well, thanks for that, Joel. And I'm going to go ahead and turn it over to Awista. Thanks again for everyone for joining today. And again, whatever Joel and I can do to be a resource to get something moving in your community, I'm more than happy to do that. Thanks, everyone.
Thank you, everyone, for joining us today. My name is Awista Atkins. Thank you, Adam, and thank you, Joel, so much for today. We truly appreciate it. My slides disappeared from the screen, but no worries. I went ahead and already launched the survey. I'm going to launch it one more time just in case if anybody would like to let us know how we did. The survey does help us find a lot by just letting us know what everybody would like for us to do in the future or anything that we can correct ourselves on. We hope you join us for our next webinar. Our next webinar is going to be on February 23rd, Utilities 101, from installation to energy efficiency. Feel free to access this and any other recorded webinars online on our website, www.nativelearningcenter.com. We have a Cathedral Webinars tab and recorded webinars section. You can click on any one of the webinars that we have done for the past 18 months. Please feel free to view them and share them with your friends and colleagues. Check out our upcoming events as well on our social media sites such as Facebook, Instagram, Twitter, LinkedIn, and Snapchat. We even have a podcast titled Hopathanga. You can find that on Simplecast, Google Podcasts, Spotify, and Apple Podcasts. Once again, I want to thank all of your participants for joining us today. Have a wonderful day, and we hope to connect with you real soon. Thank you again, Adam and Joel.
Thanks.
Thank you.